Aloha, ni hao, namaste, and bonjour. Today we're going to be talking about the profit and loss account in business. The profit and loss account ultimately shows the profit and loss a company makes throughout its after its sales revenue. So over here we have the profit and loss account for an American company. So their sales revenue starts off as 1 million. So that's what is invested into the company and how much revenue the company starts off with. And so this could be a pie company or a food company, something like that. And then we have the opening stock. So the opening stock is basically the inventory and whatever the company purchases to start up the company, and that also falls under purchases. So this is ultimately the first part of the profit and loss account, which is called the trading account. From there, you minus from the 1 million, you minus the opening stock, the purchases, and then over there you have the closing stock. And after that, after you have the sum of everything, you put them on this side of the profit and loss account, which is the third part of the profit and loss account. And at the end, you'll get a total profit for your company. So then you have COGS. So COGS is like the cost of the goods sold. So the goods are what comes into the company, and how much it is sold for is what you have as your COGS. And then over there you have your gross profit, is what you start the second part of the profit and loss account with. The second part of the profit and loss account is basically what the expenses of the company are, like expenses that are sometimes dependable, like lighting and electricity is like something that's variable, and you don't know how much you're going to use in that month or year. So after wages, lighting, advertising, and transport are all things the company can spend on. And after all that, you minus it from your gross profit. So this company, for example, got 310,000. So this 310,000 was before the tax and interest. So depending on the country you're in, over here we have America. Over here, after the tax and interest, we have a total of 255,000, and that's how you would work a profit and loss account. So there are obviously advantages and limitations for the profit and loss account. So the first advantage is like the indication of the profitability of the business. That's an obvious one. And some of the limitations is that the profit and loss account only gives a limited indication of the financial health of the business. So it doesn't take in other things, because there could be way more expenses than the ones shown on here, but the profit and loss account only gives these limited ones. And then also the other one, the advantage for the profit and loss account is it can be shown for profitability for the future. So you know what you're starting your next month with, you know what your next sales revenue is going to be. The other advantage is like the effectiveness and the design of the profit and loss account. So with all of these, you take into almost every single thing you have in consideration for your company. And with the profit and loss account, you will not go wrong in how much money you make, and it will also show investors whether they should invest into your company. Another limitation is it's based on historical data. So all this might not show how much your future is, like how much you're going to make in the future, in the next month or in the next year. And these are all assumptions on how much your goods might sell. So these assumptions will not predict a proper forecast for your business. And another last one is another last limitation is window dressing. So a lot of people, window dressing is known as when businesses cover up for what they have made. So we know many oil companies that have gone bankrupt because of lying into their profit and loss account and corrupting in their profit and loss account. So that's another limitation you have in your profit and loss account. And an advantage you might have is forecasting the future, but again, this might not be a correct forecast, and the prediction will probably be wrong, because you don't know how much you're going to spend on electricity next month, advertising and transport, and things such as